Despite high efficiency of technical indicators, the price action method of trading is still being the most popular among new and professional traders. In simple terms, price action is a trading technique that allows a trader to read the market and make subjective trading decisions based on a recent and actual price movements rather than relying solely on technical indicators. Since price action trading relates to recent historical data and past price movements, all technical analysis tools like charts, trend lines, price bands, high and low swings, technical level of support and resistance are taken into account as per the trader's choice and strategy fit. Psychological and behavioral interpretations and subsequent actions as decided by the trader also make up an important aspect of price action trades. For example, no matter what happens, if a stock hovering at 580 crosses the personally set psychological level of 600, then the trader may assume a further upward move to take a long position. Other traders may have an opposite view. Once 600 is hit, they assume a price reversal and hence take a short position. There are numerous amount of price action trading strategies out there, yet only a few of them are really effective. So in this video, I will show you the top 3 price action techniques that I personally find the best for trading stocks, forex, crypto or any other market that has a high level of liquidity. These strategies will make you huge and consistent profits, so listen carefully to what I'm about to tell you in this video and take your notes. Okay, on the third place we've got a price action trading strategy that's called 3-step trading strategy. And now let me explain the exact rules for this strategy. As the name implies, this strategy consists of 3 steps. So the step 1 is to identify the overall trend direction. This is very important because we're only going to be looking to sell when the price action is moving in a downtrend. This means that the price action is making lower lows and lower highs. And we're only going to be looking to buy when the price action is in a clear uptrend. This is when the market is making higher highs and higher lows. If you're a beginner, you might be struggling with identifying the higher highs, lower lows, etc. So in order to make it easier for you, you can add an indicator called the higher high, lower low strategy. This indicator by Lonesome the Blue. As we can see, this indicator accurately identifies the lows and highs in the market. This tool is very useful because it takes the guesswork out of the game. So as I said, in order to take a short position, we're going to be looking for a clear downtrend. A clear downtrend is identified when the market is making at least 2 consecutive lower lows and 2 consecutive lower highs. We also seen that the price action has broke below the previous level of support, and this level actually became a new resistance. So once you identify the market structure, you're going to be moving to the step number 2. The step number 2 includes 2 actions to prepare for the move and anticipate where the price action is going to go in the near future. In the example we're seeing right now, the price action can either continue to move upwards or it can simply bounce off this new level of resistance. If the market bounces off and creates at least 3 consecutive bearish candlesticks, you're going to move on to the step number 3, which is to take action and enter the trade. As we can see, the market respected a new level of resistance and it also created 3 consecutive bearish candlesticks. So now we can go ahead and take a short position. Our stop loss will be set slightly above the recent level of resistance. And for this strategy, we're going to be targeting 1 to 1.5 times the risk. As we can see, the strategy is very easy to follow and most importantly, it has a really high success rate. Okay, let me show you one more example for short positions. Here we can see the market is in a clear downtrend. This is confirmed by the indicator that found 2 consecutive lower lows and lower highs in the market. We also seen that the previous level of support was broken. The market bounced off the previous level of support, which became a new resistance. And it created at least 3 consecutive bearish candlesticks. Okay, now let's understand the long positions. So first of all, you want to identify the obvious trend direction. The bullish trend is confirmed when the indicator is making 2 consecutive higher lows and higher highs in the market. We also seen that the price action broke above the previous level of resistance, then it created a pullback where the previous level of resistance became a new support. The second step is to prepare for the move and anticipate where the price action is going to go in the near future. In the example we're seeing right now, the market formed 3 consecutive bullish candlesticks. This gives us a strong belief that there is a high chance that the market will continue to go in the same direction. So we move on to the step number 3, which is to take action and enter the trade. The stop loss will be set slightly below the recent level of support, and we're going to be targeting 1.5 times the risk. Also notice how powerful this indicator becomes once the market starts moving sideways. We see that the market usually does not respect the rules for entering long or short positions. Okay traders, I hope you have understood the rules for the strategy. Definitely give the strategy a try, but make sure you do your proper backtesting before trading live. Alright, now let's move on to the price action strategy number 2. Okay, so the second strategy is based on the Fibonacci retracement tool. I'm not going to get into details of what the Fibonacci sequence is because I don't want to make this video too long. If you want to learn the Fibonacci basics, please watch this video right here. So first step will be to select the Fibonacci retracement tool. The second step will be to identify the major swing low. In this example, we can see that the major swing low level is right here. The next step will be to identify the major swing high. And finally, you want to draw the Fibonacci retracement from the major swing low to the major swing high. By the way, in the star section of the Fibonacci retracement tool, you want to enable 4 key levels, which are the 0, the 0.38, the 0.61 and the 1. For this strategy, we also need to use an exponential moving average to confirm our entries. The EMA will be set at the length of 50. So for a long entry to be valid, the price action must pull back into 50 EMA, where the candlestick crosses and closes below the moving average. The candlestick must also touch either 0.61 or 0.38 Fibonacci levels. Once we have that, we're going to be waiting for the candlestick to cross and close above the 50 EMA. This will be our final confirmation. A buy order will be placed at the close of the trigger candlestick that broke above the EMA. The stop loss will be set slightly below the 0.61 Fibonacci level. And for this strategy, we're going to be targeting 2 times the risk. As you probably noticed, this is also a trend following strategy. We see that we're not catching reversals, we're simply going with the prevailing trend. Okay, let me give you one more example. Here we see the price action started moving in an uptrend again. We draw the Fibonacci from the major swing low to the major swing high. And now we're going to be waiting for the price action to touch one of these 2 Fibonacci levels and at the same time to cross below the 50 EMA. Okay, here we see the price action respected the 0.38 key level, and it also crossed and closed below the EMA. A few candlesticks later, the market closed above the EMA. We see that our rules are met, and now we're going to go ahead and take a long position. In this case, the stop loss will be set slightly below the 0.38 level, and we're going to be targeting 2 times the risk. Okay, now let's understand how to take sell positions with this strategy. For that, we need to first identify the major swing low and the major swing high, and then to draw the Fibonacci from the major swing high to the major swing low. Next step will be to wait for the price action to pull back into one of these 2 Fibonacci levels. And most importantly, the price action must cross and close above the 50 EMA. In this case, we see we have a pullback into 0.61 level, and now for an entry confirmation, we're going to be waiting for the market to cross and close below the 50 EMA. Alright, here we can see that we had a cross, and now we can confidently enter a short position. Our stop loss will be set slightly above the 61 level, and we're going to be targeting 2 times the risk. As we can see, the price action immediately hit our take profit target. Okay, let's see one more trade example. Here we draw the Fibonacci from the major swing high to the major swing low. The market pulled back into 0.61 level, and it also crossed and closed above the EMA. Then we had an entry confirmation, and as we can see, this trade turned out to be extremely successful. By the way, traders, this strategy works the best on a higher time frames because there is less noise and manipulations in the market. So yeah, definitely give this strategy a shot, and I'm sure it's going to be making you a lot of money. Okay, now let's move on to the strategy number 1. The supply and demand zone strategy is a very popular technique that's mainly used for trading stocks. As you probably know, the stock prices are a direct result of supply and demand. All the other influences like debt, balance sheets, earnings, and so on affect the desirability of owning a stock. If a company surprises stock owners with low earnings, demand for the stock may wither. As it does, the equilibrium between buyers and sellers of the stock is changed. Future buyers will require a discount in a stock's price, and many sellers will be motivated to accommodate. More sellers than buyers means that supply will exceed demand, so the price falls. At some point, a stock's price will drop enough that buyers will find it attractive. As buyers move into the market for a stock, demand grows faster than supply, and so the price will increase. With that being said, how do we actually apply this knowledge on practice? So when looking to buy, you want to identify a strong bullish candlestick that initiated an upward momentum after a strong bearish trend. Such candlestick is an indication that the buyers finally stepped into the market. This is also a new demand zone. The next step will be to wait for the price action to pull back into this zone. And once we have such pullback, we're going to be waiting for an entry confirmation. We're going to enter a long position as soon as we have the price action closed above the most recent bearish candlestick. Our stop loss will be set slightly below the demand zone so that we don't get stopped out. And for this strategy, we're going to be targeting 1.5 times the risk. Okay, let's see one more long example. Here we see the price action was moving in a strong downtrend. Then we had a strong bullish candlestick that pushed the market up. So we will draw a rectangle that identifies our new demand zone. This is where the buyers started showing some interest in buying a stock. Once we identified our demand zone, we're going to be waiting for the price to pull back into it. And for our long entry confirmation, we're going to be waiting for the price action to create a bullish candlestick that would close above the most recent bearish candlestick. The stop loss will be set slightly below the demand zone, and we're going to be targeting 1.5 times the risk. As we can see, this strategy can be really effective when used correctly. Okay, now let's understand how to sell the stock by using this strategy. So first of all, we want to identify a bearish candlestick that initiated a downward move after a strong uptrend. Remember, the bearish move must be really strong. The next step will be to draw a supply zone. And then wait for the price action to retest this zone. For a short entry confirmation, you're going to be waiting for a bearish candlestick that closes below the most recent bullish candlestick. The stop loss will be set slightly above the supply zone, and you're going to be targeting 1.5 times the risk. It's very important to take the positions only when we see that the market is overextended. By the way, traders, if the price action does not respect the recent supply zone, you cannot be entering a short position. You can only enter the trades when the market did not exceed the level of supply or demand. Okay traders, I hope you found this video useful. Be sure to click the like button because it really motivates me to create videos like this more often. By the way, if you want to see one of my best trading strategies on the channel, check out this video right here.